And I spent close to 10 years studying companies as a stock analyst when I was on Wall Street in equity research at BMO Capital Markets. In this video, I'm going to share with you the top 10 signs of valuable companies that I've seen, and each of these companies have completely beat the market. Most of them have returned at least 2 to 3 times more than the S&P 500, and some of them even as close to 10 times the return of the S&P 500 index. I'm Henry Chien. I spent 10 years on Wall Street as an equity research analyst, and now I teach investors like you how to make money with stocks using Wall Street methods. And if you want to learn more about the fundamental investment framework, just check out the link below. We have resources for you, including a free workshop. Let's go into the top 10 signs of valuable companies. I want to walk you through each sign with the company and also take you through the financials so you can see exactly how that turns into returns. First thing is operating leverage. Now, there's this company, Gartner. It sells enterprise research to big companies. Now, Gartner is very good about tracking and improving the productivity of their sales force. And so as Gartner grows its research business, the productivity of its sales force also grows, and that improves its profit margins and its earnings growth. Now, operating leverage just means that costs, and it's usually costs of running the business, tend to grow slower than sales. And that leads to higher profit margins and usually leads to higher returns and higher earnings growth. That's usually a function of if a business can control its operating costs, either their fixed costs, or it can figure out how to make the costs more productive, just like with Gartner in their Salesforce productivity initiatives. And so what happens is that turns into a margin boost and leads to stronger earnings growth. Here's what operating leverage looks like. Operating leverage just means that costs are growing slower than revenue. So what we should see if we have operating leverage is we should see one of the operating margins. So EBITDA, so that's earnings before interest, taxes, depreciation, and amortization. That should be going up over time if there's operating leverage. So if we start a little bit early on, we can see EBITDA margins were close to 14%. They've started to go up to 17%. There was this period here in 2017, 2018 where they actually bought a new business, and that's why margins came down. But you can see after they integrated that business, margins went up quite a bit to 24, 25%. That's a really big trend, upward trend in margins, 13 to 24. And so what happens if you have a margin increase? So you say we have our revenues that are growing 10 plus type percent every year. Because margins are growing, earnings per share is probably growing a lot faster, close to 15 to 20%. It's a little messy in these years, but you can see that it's growing really fast some years, 40%, 25%. Basically, when you have improving margins, it grows your earnings a lot faster. So the black line over here is the earnings per share estimate. That's just grown by a ton, just upward with the exception of a brief contraction of the COVID recession. But you can see that earnings per share has gone from $2 to $11. That's a 5 times jump. You can see that's what's happened with the stock price as well. It's gone from 80 to about 470. So you can see that the earnings growth has directly translated to stock price growth for Gartner. And you can see from this performance chart over here, Gartner's the blue line over here. This is how Gartner is able to achieve close to 580% return versus the S&P 500, 232% return. And that's a compound annual growth rate, or a CAGR, of about 21%. So awesome returns. So number 2 is proprietary data. Now there's this company, MSCI. It's an index company. It makes indexes like the emerging markets equities index. That's a very popular benchmark for investors who have funds that invest in emerging markets. And what MSCI has done is they designed and created this index, and they own all the intellectual property. It's very difficult for a competitor to come in and recreate the index because MSCI has done all the research, they have the designers, and so it's very difficult for anyone to come and copy. When there is no one that can copy the product, it means there's very little competition. So now almost all fund flows that go into these emerging market investment funds, almost all of them use MSCI's index as a benchmark. So sales are a lot more stable because MSCI is the only one that owns that data. Without that competition, sales are just a lot more predictable and a lot more compounding. Okay, so for MSCI, we know they have proprietary data. What we should see is that very stable, consistent revenue growth. And you can see that over here. This top line, revenue growth is very stable. It's generally between 7 to 10%. Of course, it's accelerated in some years, but it's very stable, consistent revenue growth. Now, the thing is with MSCIs, they actually do have operating leverage as well because they're able to keep their payroll costs low by spreading it around the world. And because they're selling a data product, the costs of selling that product are actually quite low. And that's why you can see that gross margins are very high. EBITDA margins, operating margins have also increased too. And they're just very high margins, 82%, 57%. Usually that's a sign that the company has some sort of proprietary asset or some sort of proprietary thing, that because that means when they have such high margins and no competitor can come in, that's how they can preserve that high margins. Now, here's another thing about MSCI. Because they own all that intellectual property and no one is really coming in and stealing it, that keeps the prices of those assets stable. So they don't actually have to keep reinvesting that much capital to stay competitive. And what that does is it leads to very high returns on capital, because you don't have to invest that much capital, but you're generating a lot of returns. You can see that MSCI, this is the blue line, has gone from 9% returns on invested capital to 31%. And that's a crazy increase. That's really high. And you can see what happens here. If you think about it, if a business is generating really high returns on capital, right, it's, as an asset is generating 30% returns, that should mean that it should become more valuable. And so that's exactly what's happened here. The price to earnings ratio has gone from 20 times back in 2014, and now it's all the way gone up to 38 times. And that's actually pretty reasonable because this business is now generating a really high return on capital. Okay, so you can see for MSCI as well, because they've had this continuous growth, their margins are improving, so earnings per share has also grown by a ton, and that's how you can see how the stock's value has also increased as well. And that's a big driver of the returns that you get as a shareholder, as the earnings growth. So the combination of that earnings growth plus that increase in valuation, that's how MSCI was able to grow at 1,000+% versus the S&P's 230%, or a 30% CAGR or annual growth each year. And that's how MSCI was able to achieve such high returns for its shareholders. Third thing is if a company is embedded in its customer workflows. There's this company, FICO. So every time a bank runs a credit card application for a loan, FICO gets a request to create a FICO score. And the FICO score is used by the bank to make decisions on whether or not to approve the credit card application or not. Now, it's very difficult to replace FICO because FICO's decision-making engine is literally embedded as part of the bank's workflow process. And once FICO also moved that decision engine into the cloud and used it for all of its different customers, it also saved a ton of costs. You can imagine there's one decision-making engine serving thousands of banks. Now, embeddedness is also one way that competition becomes reduced. So sales compound and prices can go up and margins generally improve if the business product is a key part of its customer workflows. So here we got FICO's financials. Because FICO is really embedded in the bank's workflow, we should see very stable revenue growth. And we can see that's exactly what's happening here. We have about 6, close to 10%, very stable revenue growth because they are literally embedded as part of the workflows of their bank. So that's why their services are continuously being used and required. And because they've also shifted this all to the cloud, which has reduced their costs, combine everything into one decision-making engine, they've also been able to improve their margins. And that's how EBITDA margins have grown from 20+% to 40+%, which is also an amazing increase in margins. So you can see for FICO as well, because they've been able to grow their earnings and keep capital relatively constrained, that increases the returns that they're getting in the business on their capital. And so that's how they've also been able to grow their returns on capital from this 8% level to a 43% return on invested capital level. So that's really amazing. And you can see that's why the valuation has also went up so much. It's gone from 13 times to close to 52 times. And that's because the returns of the business are so high right now. And that's why the stock is much more valuable. FICO's earnings growth has just gone up and the price of the stock has gone up with it. So the price returns have generally matched the earnings growth of the business or the earnings per share growth of the business. So you can see that FICO, it had really great earnings growth, and that's how it's able to achieve such great returns all the way up to 2022. But you can see that also that additional boost from when they converted their business into a cloud business and really boosted their margins, that really increased returns on invested capital. You can see that as a result of that huge increase in return, valuations also increased. And that's how FICO was able to amazingly generate over 2,000% in returns versus the S&P 500. This is 10 times higher return than from the S&P 500, which is crazy. This is close to 38 compound annual growth rate, so 38% in annual returns. Crazy. This is an amazing stock. Fourth thing is a low cost of replication. Now, there's this company, CoStar. If you were to sign on for CoStar, they sell real estate data. All CoStar has to do is just give you a login, and then you can easily just go onto their website and their web portal and access their data. So the cost for the product for adding on new customers is basically zero. And CoStar's model is they acquire a lot of smaller data sets and pretty much just bundle them into a data service and sell it as a subscription to their customers. Now, what happens when the cost to replicate is really low is you have very high gross margins. So what happens if you have really high gross margins is you're making so much more money from each new customer because the costs are so low. And it also boosts your earnings growth. And that's how this company was able to achieve such high returns. Here we got CoStar. So gross margins is calculated by taking revenues minus the cost of producing the good or service and delivering it. So because CoStar's cost of providing that service is very low, the cost of replication is very low, you can see that gross margins are really very high. They're close to 79%, and they've gone all the way up to 80%, which is fairly high for a business. When you just make a lot of money from signing on new customers, it also just gives you a lot of money for your business. And so your margin should also improve as well. So you can see the operating margin has gone from 26 to 29. So it's just generally increased. It looks like it's a little variable because I think there's a lot of different acquisitions that they're doing. But generally speaking, you can see that you get this stable growth. And because it's a low cost to add new customers, your margins can increase specifically because you have such high gross margins. CoStar is a little bit more volatile, but you can see that's how they've been able to grow their earnings per share. Also, pretty dramatically upwards to the right, and that's been driving the price returns. And you can see because of that earnings growth, but not so much from valuation, that's how CoStar is able to grow over 300% or about a 16% compound annual growth rate versus the S&P's 230% or 12%. CAGR. Number 5 is a secular trend. Now, this is sad, but there is a trend of obesity, both in the US and globally. And what that means is there's a lot more people with diabetes. And so that also leads to a lot of demand for companies like Dexcom that provide glucose monitoring devices that help people with diabetes manage their insulin and their glucose. What that does is it creates a really strong growth runway for the company. That growth alone can really lead to very high profits and lead to very good returns as a shareholder. With Dexcom, because there is such a secular trend of people with diabetes purchasing these products, there's so much demand. What you should see is very strong revenue growth. And that's what we see over here. It's close to 60% and it's still growing at about 30+%, which is very, very high growth rates every year. You can see this company that hadn't actually earned any profits, even as back in 2012. You can see EBITDA margins are negative. Net income is obviously negative. And even gross margins are quite low. They're about in that 40+%. So what has happened is because there's such a demand, eventually the company is able to scale, meaning they were able to start producing that product more efficiently with greater volumes. And eventually they were able to start covering all their R&D costs, all the different operating costs. So the company was finally able to start turning profitable around 2019 and 2020. And it's only when a company really turns a profit that it starts to actually become worth something to shareholders. And so that's why you can see that as soon as the company was starting to make more profits, the stock really started to work because shareholders realized that this company can now start to make money, which means it has value. And that's how the stock price is able to start going up so much because it's generally following that path of earnings growth. And so for Dexcom, also extremely high returns of over 1,000% or close to 28% CAGR. So this just shows you that if you have a very strong secular trend and just very, very strong growth, as long as the company can keep growing at those rates and eventually start covering their costs, this company does become a real winner because they can start to generate a lot of profits. Growth can overcome a lot of the weaknesses of companies if they're just not able to make money in the beginning. If they can grow enough, they can usually start to cover their costs and eventually become profitable and generate really high returns for shareholders. Number 6 is if a company can do tuck-in acquisitions. Now, what that means is if a company can start buying and integrating smaller companies, it can lead to very attractive profits for the company. Now, Waste Management is an example of this. They are a garbage disposal company. They own landfills. What they do as part of their acquisition strategy is they buy up smaller collection routes, and then they integrate that into their disposal networks. Now, what's happening here is they're acquiring a cheaper companies. So they're acquiring the earnings of those companies at a cheaper valuation versus their company. And as they integrate it, they also usually can improve the margins of those companies. So that also increases the earnings. And then that leads to generally pretty high returns on capital and also improves growth and margins. And so that's how Waste Management has been able to deliver very high returns for its shareholders. Now, waste management is a cool contrast because waste management's revenues is actually very low rates of growth. You can see it's about 2-3%. And of course, the reason is because their business is just collecting garbage. There's not really a huge increase in garbage every year. And every time they grow faster than 4 or 5%, really, that's just because they're starting to acquire businesses. So top line or revenue growth is actually quite low. But what we've seen is because they're buying earnings, they're also increasing it. So they should also see a margin increase. So that's exactly what you see, a margin increase. So you can see that's going from 25 to 27. You're integrating these companies, you're making them more profitable. There's another thing that's going on here with waste management. They own landfills. So landfills are generally pretty high margin because landfill fees keep going up. But what they're doing is because they keep buying up all these volumes, they just keep generating higher profits just from volumes because the costs of the landfill are relatively fixed, so you can start generating higher profits that way. So waste management, you can see that earnings per share growth has also grown because they're able to continuously add earnings and improve their margins, just like these other companies. It's because they're able to buy companies and buy up those earnings at a lower cost than their current multiple. What that does is just increases the returns that they're getting on their capital. So you can see the same way with waste management, even though they're not a very super strong grower, they're also able to increase the returns on capital from 9% to 14%, which is not shabby, even though it's like not growing so fast. And so that's how price to earnings ratios have also increased by that amount. And because it's a very stable company, that's why the price to earnings ratio is probably a little bit higher than a company of this type of growth rate. What happens here is that waste management also has strong returns because of that growth in earnings, as well as the increasing returns on capital also boosts its valuation. That's how this company is able to achieve a 20% type CAGR, 20% annual growth rate every year, or 530% return versus the S&P about 12 and 230% return. Number 7 is low cost of capital. And this is something that Berkshire Hathaway does. So this is Warren Buffett's companies. They own several insurance firms, including Geico. And so that gives them capital that they get from selling insurance. It comes from the premiums. Now, Buffett, with his investment teams, will invest those premiums into high returning stocks. Now, the usual model for an insurance company is to invest in something like bonds or fixed income instruments, but those have a lower return. So Berkshire's Hathaway models, they've basically taken a low cost source of capital, almost zero cost because they're just collecting it from their customers, and they can invest that into stocks, which are a lot higher returns. And so what happens is they're buying stocks, the assets go up, their liabilities, which are the insurance payouts, they're also going up, but not as much. And so that leads to an increase in book value. And that's how Berkshire Hathaway has been able to grow so large over these past few years. So Berkshire Hathaway's company is really interesting. I'm actually going to have to skip the income statement because the model here, as you know, is they're actually taking cash from their insurance companies and they're putting it into stocks. So I want to skip over most of the balance sheet here and just point to this line over here. What they're doing is they're taking this money that they're getting from selling premiums, and that should cover the liabilities if they have to pay out on the event of any fire damage or property damage. So that capital is saved up to pay out, but they can allocate a portion of that into stocks. And most insurance companies might do fixed income or bonds, but they're doing it to a higher returning asset. So that leads to their asset side should start to increase faster than their liabilities. What that does is that should increase the equity or the overall book value of the business. And that's exactly what's happening here. You can see the book value has started to increase, and it's increased year after year. And so it is actually very impressive that Berkshire has been able to increase their returns from just book value alone, basically as much as the S&P. Berkshire, because it's so big, it can't grow that much faster because it's just so big. There's only so many businesses you can keep buying. But Berkshire, even now, has still outperformed the S&P because of this model, because they're able to take very low cost capital, and obviously because of Buffett's team and his investment decision making is able to turn that low cost capital and put it into high returning assets. And over time, that leads to an increase in book value per share. Number 8 is positive working capital, or just generally very efficient capital use. Amazon is a great example of this. So Amazon actually collects money from its customers before it pays suppliers. Usually most retailers will purchase inventory or products or different types of goods and then sell it to customers. Because Amazon was able to grow its marketplace, they kept getting a ton of cash from their customers upfront, which both allowed them to expand their marketplace, but also gave them a lot of capital to invest in new products and even new businesses. And then these new businesses will continue to generate more cash. And that's how the model of Amazon works. They can keep compounding that growth in cash flow. And that's what's drove the returns of this stock. Amazon is an awesome example from a cash perspective because they're able to take in a lot of cash from their customers up front. You can see it as they grow their revenues. If we go back a couple years ago, most of it was really in the marketplace. So that's where they're selling all their goods. You can see that increase in revenues was also directly matched by an increase in cash from operations. They were able to use that cash to make their investments. And that's exactly what's happening here. That's their capital expenditure. They would be able to invest all that cash flow from operations into capital expenditure. And those businesses that they created with those investments turned out to things like AWS or all these new products for their marketplaces. And so that's how they were able to continuously grow revenues. And that's also why, if you look at it from a profit standpoint, they actually kept their profits quite low. So their margins were very low, gross margins quite low, because they focused mostly on just getting cash from customers and keeping reinvesting and focusing on generating cash. So for Amazon, we should really be looking at free cash flow per share. So you can see that's what the blue line here is here. Obviously, there was like a crazy dip at 22, but overall, you can see that's where the growth of Amazon is coming from, is from that overall increase in free cash flow per share. And that is what has led to that huge increase in their share price. They've grown at about 868% relative to the S&P's 230%, and that translates into a 25% CAGR, so year after year, 25%. And that's also amazing returns. Number 9 is networks. Now, if you look into the credit card industry, almost every single credit card transaction goes through one of 3 networks: the Visa network, the MasterCard network, or the American Express network. And so if you're a retailer and you want to accept credit card payments, you're probably going to want to take cards that are based off one of those networks. And usually that means Visa, because Visa is the largest. What happens is this network gets stronger and stronger. More people use the network, more people want to join that network. It just leads to very little competition for Visa. And so what that leads to is a very consistent sales growth, very high margins, and that type of earnings growth is what led to very high rates of return for shareholders of the stock. So we can see that they have very stable rates of revenue growth over here on the top. We also see extremely high margins, so 96% and 68%. So that's just another indicator. They just have a huge competitive advantage because no competitor can come in and take any of those profits because they have such a strong position. Also, it's reflective of the fact because it's all electronics, so costs are quite low, but these are very high margins, right? So we're talking 68%, so 70% margins, very high. We can see for Visa, because they have such stable growth in revenues as well as an increase in margin, you can see earnings per share has grown up, and that has driven the stock price up as well. And of course, because they're generating so much profit and not requiring that much capital to be reinvested, their returns on invested capital are also extremely high. It's grown from 9% to close to 30%, so also very high. You can see that's how the multiple has also increased as well. The PE multiple has increased from about 15 to about 27. You can see from those two drivers, we got the earnings growth plus the increase in returns on capital to boost the valuation. Visa's return is 440%, which is awesome, 2x to 230% of the S&P 500. That's about an 18% CAGR every year, so really great returns, and that's how it's able to achieve that. Number 10 is physical assets. Example of this is Clean Harbors. They're a waste disposal company. They actually own most of the incinerators that are used for hazardous waste, usually made by industrial companies in the US. And now these assets are very valuable because one, they take a lot of capital and regulatory approvals to build. It's very difficult to just build a new incinerator. And number two, incinerators are also one of the few ways that industrial companies have to dispose of their hazardous waste from a regulatory perspective to comply with laws. So put these things together, you get a very stable source of revenues from these industrial companies. So revenues basically move along with industrial activity. And you can also get a good rate of return because if there are no options, you can price that service in a way that gives the owner of that incinerator a good return. So that's exactly what happened. Clean Harbors was able to see fairly stable revenue growth just tied to industrial activity, as well as good margins and good returns on capital. And that's how it's able to generate earnings to create returns for its shareholders. The last one here is Clean Harbors. So they are the ones that have the asset, the incinerator. So what we should see is very stable growth. Now, because they provide disposal service to industrial companies, it's very much related to industrial activity. So that's why it's not stable from the perspective of just looking at it year to year, but it is stable in the sense that it tracks the industrial activity pretty closely, but it's not as volatile as industrial activity. We see relatively stable revenue growth just matching the activity of the industrial sector, but we also can see that gross margins have started to increase. Overall, EBITDA margins have also increased from 15 to 16%, 19%. So we see that increase in margins because they own this asset, one of the few assets available for disposal services, and they can charge a reasonable price for it so they can get a decent return. They also have pretty solid earnings growth. Obviously, it's a little more volatile because of the swings in industrial activity, but you can see earnings growth has also gone up, and that's led to an increase in price. We have the earnings growth. Now, it's taken a little while, but Clean Harbors as well, even though it's an industrial company, it's not the fastest growing. It's a lot of expenses. That's also growing close to 300% relative to the 230% of the S&P 500. So they're also outperforming. And you can see that's because they own these assets that not a lot of other companies have. The takeaway here is over the long run, you can get much higher returns from stocks when you invest in great businesses. And the way to do that is you want to analyze them and you want to start paying attention to signs like these because you want ideally a very high rate of return or as high as possible, as well as earnings growth. And when you combine those two, you get really high returns as a shareholder of the stock. When you invest in these companies, your money is just making money for you. It's growing 20% every year after year. That compounds. And the great thing about that is you don't have to do anything. It's doing it all for you. And honestly, I wish I understood a lot of this stuff when I was younger. Even though I invested as soon as I could when I was just starting working, I put most of it in index funds because I didn't really have a framework for picking individual companies. That actually took a while to learn. And in retrospect, if I had this framework, I could have had much higher returns and just had a lot more money. Here's how I realized this is I was actually one year I decided to do an experiment. So I was trading a lot. I had two accounts. So one account, I was doing a lot of active trading. I was trading things like futures. I was just going back and forth and really just trying to trade different macro moves, trading different stock ideas. And so there was like a long list of stocks. There was a bunch of trades in and out. I was looking at it every day, following the news. And then I also had this other account, which was a account where I just used a lot of the frameworks that I've touched upon and picked some of the highest quality companies that I've heard of through my work and through my research of companies. I picked 4 companies, I put them in this brokerage account. I didn't even look at it. And then a year later, so my trading account doubled. I was really happy, felt like I knew what I was doing. I opened my brokerage account for the first time. I haven't checked it for a year. And then boom, like I'm talking 120% returns, 80% returns, something like, I think the worst was maybe 60. It's probably another one that was like 80 or 90. I can't remember. It was 4 companies, FICO, Acuvia, CoStar, TransUnion. And so in my mind, I was like, okay, so I spent so much time with this trading account. And then this brokerage account, I literally spent 0 time looking at it. And it's doubled. I always wanted a double in buying stocks because then I would know, okay, I probably know what I'm doing. And I had already a double from these stocks that I'd never looked at for an entire year. And so that's when I realized, okay, I need to quit this trading nonsense and just learn to focus my capital on just buying quality companies using the frameworks that it's taken a while to develop, but that I'm sharing with you right now. So that's what I hope to share with you so that you can do the analysis and find companies and really get to investing and get really high returns, because the sooner you do it, the more you can benefit from compounding and really get those crazy returns. So I really want to see you succeed in that. So if you like this, subscribe or comment. It'll tell YouTube to give you more content like this. It helps us make more content that you like. And of course, if you ask a question, we'll also get back to you. And generally, feedback will just help us make better content for you. Finally, so if you're active in markets and you want to get trained in these skills, there is an accelerator program that we offer for individuals like you to train you in the framework of finding quality companies and ultimately so that you can pick better businesses, improve your returns, and make more money with your money. So all you have to do, if you want to check that out, is just check out a link or just reach out. And thank you again for watching, and I'll see you in another video.